to another video from Q2of4 Solutions. You're currently watching the support videos for the British International Distance College Accounting module. I'm going to be taking you through assignment questions and answers so that you've got a better idea of how to approach accounting. Visit the website for more information and follow us on Instagram and Twitter, and keep watching the YouTube channel for more support. This is our third-party disclaimer. I just want to acknowledge that Q2of4 Solutions is a private institution and is by no way connected to the British International Distance College. Any reference made to the subject material referred to official BIDC material, and we do not represent them as our own. We simply work through the BIDC material with students as a means of additional academic support. Currently, we're going through assignment 3. We're now going to move to question 2. So let's begin. Question 2 in the assignment pack is on page 38. Question 2 states, Sam's financial year ends on 31st March. On 1 April 2015, balances in Sam's ledger include the following. They give you machinery, 50,000 debit, and they give you a provision for depreciation of machinery, 14,000 credit. So that's what you've been given in the actual question. We now need to apply our knowledge and information that they've given us in the additional part of the question to then prepare these T accounts. Then they say you've been given the following further information. On 31st June 2015, Sam sold a machine for 6,000. This machine originally cost 15,000. Depreciation written off on the machine. Depreciation written off the machine up to 31st March 2015 was 7,000. That's fine. They've given you that information. Then they say on 1st October 2015, Sam bought a new machine for 25,000. Paying by check. Sam depreciates this machinery at 10% on the cost of machinery held at the end of each financial year and makes no depreciation charge for machinery sold during the year. A. Prepare the following accounts in Sam's ledger. They want machinery, they want provision for depreciation of machinery, and they want the disposal of machinery. Then B. Prepare an extract from Sam's statement of financial position as at 31st March, and they also want you to explain how Sam observes the accounting concept of prudence by providing for depreciation on his machinery. So that's something that we're going to have to look at. So to start off, let's create those T accounts, and then we're going to have to draw a diagram for the year. The first T account they want is for machinery. So let's draw that one up. Machinery. Then they want the provision for depreciation of machinery. So let's draw that as well. Provision for depreciation of machinery. Depreciation of machinery. Which, another name, again, depending on your textbook, depending on your theory, you could either call this accumulated depreciation. It all depends on background and different institutions. They call it different things. At the end of the day, they're all assets or liabilities, income or expenses, capital drawing. So this would obviously be a negative asset. Machinery would be an asset. Then they want the disposal of machinery T account, which is a working account. It doesn't have an element. Disposal of machinery. Perfect. So those are the 3 accounts they want for A. Then obviously the extract a bit later with financial position, and then we've got C, which is a theory question, which we'll look at just now. Right now I want to draw a timeline. So we need start and we need end. Start of the year, end of the year. They tell us Sam's financial year ends on 31st March. Then they say on 1st April 2015. So 1st April 2015, we had the following balances for machinery and provision for depreciation of machinery. So those are opening balances. We can record them in our T account so we can get the mark for it. So we've got 1st April 2015, balance brought down, and for the provision for depreciation we also have a balance. We've got 14,000 on this side and 50,000 on that side, given in the question. Then they say, you are given the following further information. Okay, so now we know we've got further information. Obviously that's the start of the year. The end of the year would have been March, so 30th or 31st March 2016. That would be the year end, if that's the start. So always draw a timeline and show what's happening during the financial year. They say, you are given the following further information. On 30th June 2015, so that's during the year. So 30 June 2015. Sam sold a machine for 6,000. Sale, so sold. And that was for 6,000. Machinery 6,000. Proceeds. That's what we've got. This machine originally cost 15,000. Depreciation written off the machine up to 31st March 2015. So up until that point in time, 31st March 2015. So we know what the cost is of this machine. We need the cost. I'm going to use accumulated depreciation. It's shorter to write instead of writing down provision for depreciation of machinery. Okay. They told you the original cost was 15. What else do they say? They say depreciation written off of the machine up to 31st March 2015, which is that date, was 7,000. That's how old the asset is. The next point, point number 2, on 1 October 2015, so let's put that in, 1 October 2015, they say Sam bought a new machine, so new, he bought a new machine for 25,000, so cost equals 25. Paying by check. Sam depreciates his machinery at 10% on the cost of the machine held at the end of the financial year and makes no depreciation charge for machinery sold during the year. Great. So that's what we've got. So you've got two things here. You've got the disposal there, and you've got an acquisition there of a new asset. So you've got existing assets as well, and you've got assets that are bought and assets that are sold. So what do we need to do now? Well, we've got a good idea of what the picture looks like. We've been asked to do two things, three things: the machinery, the disposal, and the provision for depreciation. So let's first start with the easy bit. Did I have this new machine for part of the year? Yes, I did. So would I depreciate that machine? Yes, I would. So if I'm looking at the new machine, obviously at some point in time you bought new machine, so I need to show that on 1st October 2015. So 1 October 2015, I bought new machinery. And they said in the question that on 1st October, Sam bought a new machine for 25 and he paid by check. So bank would have been affected, cash payments journal, and you would have recorded an amount of 25,000 here for the machine that was bought. It's going to increase the assets, that's going to go on the debit side. Did you use that machine for part of the year? Yes, you did. How many months? Well, October to March. So October, November, December, January, February, March. I count 6 months. So if it's 6 months, you've used it for half the year. So I then need to calculate depreciation. Depreciation for that term is going to be calculated at what? 10%. That's what the question said. Sam depreciates his machinery at 10% on cost, held at the end of each financial year. Perfect. Okay, so depreciation will be the 25,000 times the 10% times 6/12, half the year. And that's going to be recorded in our depreciation account. So we would debit depreciation, and then we would credit the accumulated depreciation. Obviously, in this particular textbook or module, they refer to it as provision for depreciation. Okay, it's just a different word for the same thing, so I'm going to record that on this side. Okay, I'm going to record depreciation separately for all of these different assets and liability, or assets. Okay, so I'm going to show, this is obviously year end, so 30th of March, 2016. I'm going to show depreciation, and this is asterisks for the new equipment. Obviously general journal, and it's going to be an amount of 25,000 times 10% times 6/12 gives me 1,250. That's the depreciation that would have arose on the new asset that you've bought. So I bought the vehicle, okay, well, not vehicle, excuse me, okay, I've bought the machine, and I've depreciated the machine for a portion of the year, 6 months. Great, so 2 is actually the easy bit to complete. Now we need to go back and we need to look at the asset that we sold. So if I'm selling an asset, do you guys agree, if I'm looking at the asset, I need to bring that asset to that point in time because timing is important. So currently the asset's not sitting at the right point in time. I know what it costs and what's its accumulated depreciation there. I need to take that asset to that point in time before selling it, because this is a portion of time that the asset has been used for. So in order to provide for that, I then need to do a calculation. So how much depreciation will I have? Well, let's check. Depreciation here is going to be, they told us in the question that machinery is 10% on the cost of machinery held at the end of each financial year. So if it's 10% on the cost, that's using straight line method. So we'll have 15,000 times 20% times, we've got April till June, which is April, May, June, 3 months, 3/12. That's going to be the depreciation. So again, I need to record that. Depreciation on the old asset sold is going to be recorded here at an amount of 15,000 times 20% times 3/12, 3/12. That gives me 750. That's the depreciation for that period in time. Maybe I should color code this so you guys know what each of these amounts are, but as long as you're following, you should be okay with understanding what is happening here. Great, so we've got those 2 line items. Then I know at this point in time I'm going to be selling the asset. So if I'm selling the asset, the machinery is going to decrease because I'm selling an asset. The asset that I sold costs 15,000, so I'm going to have to remove that. So this happened on the 30th of June 2015. You would have recorded of June / 2015 asset realization, or they call this disposal of machinery account, disposal of machinery. That would have been general journal, and the amount that was disposed of was an asset worth 15,000. We read that earlier in the question. Right, so this is going to be transferred to the disposal of machinery. There's the credit, here's the debit. And this is from the machinery account. So same details here, except we're going to not call this disposal. It's coming from machinery. That's the cost of the machinery that you've sold. If I'm selling the machine, I need to take out its accumulated depreciation. So we know that there was 7,000 at the beginning that needs to come out, and there's an additional 750 there. So I'm going to be taking out depreciation of the asset that I've sold. So the date is important again, so let's take the date, and I'm going to be recording the, okay, disposal machinery is perfect, that's fine, I can leave that description there, and all I'm going to do is take the 7,000 that you started with plus the depreciation that you had for during the year, because all the depreciation needs to come off of that particular asset. That's the debit, so you're going to have a credit here. equals 7750. And this is going to be referenced from the provision account. So we just need a reference for it. I'm going to talk about accumulated depreciation / provision for depreciation on machinery. Okay, it's a very long description to describe the depreciation that you need to provide for on that particular asset. Okay, and that's pretty much where we are now currently in terms of working. So we've established what the asset costs, and we've recorded that in our books. We've also recorded the depreciation. Right, in order to complete this disposal, we need to record the proceeds. So we sold an asset for 6,000. That's what they said in the question. If I go back, they say on 30 June 2015, Sam sold a machine for 6,000. We don't know if this was cash or credit, but we can assume it's cash. So we can assume that Sam received the actual income. So bank would have been debited, and the disposal would have been credited of or worth 6,000. That's going to be 30 of the 6, 2015, bank, cash receipts journal, assuming that we received it cash. That's going to be recorded there. Then I can just balance this T account off, and I'll either have a profit or a loss. So looking at this, which side's bigger? Well, 6 plus 7 is 13, so this side is bigger. This side must be the same as that side. So this minus those two credits gives you an amount of 1,250, which is credited here. And if it's credited here, it's going to be debited in the loss on sale of an asset. So 30th of the 6th, 2015, we're going to have loss on sale of an asset, or loss on sale of machinery. Let's use what they gave us, loss on sale of machinery, and we'll record that there. And the reason I do that is because if I look at the carrying value of the asset would be its cost less its accumulated depreciation, which gives me that amount. And now you sold the asset, sold for 6,000. So obviously there's a loss here. If you have an asset that has a carrying value of 7,250 and you sell it for 6,000, there's a loss. So you can either interpret it using that analysis, or you can just do it in the actual account, which I've done over there. And that concludes the disposal of machinery. So I've sold the machine, I've taken all of that through, that's perfect. All I need to do now is consider, well, how much existing equipment do I still have in the business? Earlier, we looked at balances. So do you guys agree, when looking at the opening balances, we spoke about this, the cost. That was at 31st March, which is the 1st of April 2015. Of the 50,000 Rand worth of machinery, there's a portion that was sold and a portion that's still owned. So we know that the cost of the machine that was sold was 15. So the existing machinery was or is 50 less 15, 35. And have you used that for the entire year? Yes, you have. So would I have to provide for depreciation for that? Yes, I would. So the last line item here is for depreciation on the existing. Depreciation on the existing vehicles. Not vehicles, sorry, I don't know why I'm saying vehicles. I've got vehicles on my mind for some reason. It's not vehicles, it's machinery. Okay, so when looking at provision for depreciation of machinery, I'm going to record the 35,000 times, they told us in the question, 10%. Times 10%, which is 3,500. That would be the depreciation for the year for the existing assets. So now I've got the depreciation for the existing assets, for the new and the sold, and the asset that was sold, and I've depreciated it, and I've removed the old asset. All I need to do now is balance these accounts. So these accounts I can balance. I'm looking for which is the biggest side. So total. Here, sum up $75. I want that on both sides. Sum up the credits on that side. Gives me an answer. Then the balance brought down, balance carried down. So this minus that. This minus that. Gives me balance brought down, balance carried down on the last day of the year. So last day of the year would have been 31st March, 31st/3/2016. The date, come on, 31st/3/2016. Balance carried down 1st of April 2016. Balance brought down, and I would then show balance brought down, carried down, and I would do the same thing for this side of the account, and I would show the balance that we've carried down over there, and that's what we've got for this particular T account question. If I go back to the question and just reread, okay, we've got the balances, we did the adjustments. They said prepare the following accounts in the general ledger. Have we? Yes. Machinery, that was 4 marks. Provision, that was 4 marks. Disposal, that was 5 marks. That's what they wanted. Perfect. So we've answered A. B. 2B. 2B says, prepare an extract from Sam's statement of financial position as at 31st March 2016 to show how the machinery would appear. Great, that's nice and straightforward. So extract of the statement of financial position. Obviously we're looking at the non-current asset section, non-current asset section, and under the section you'll have machinery, which will show in brackets. The machinery would be shown in terms of closing balances. What date was this? Yeah, 31st March 2016, which is the end of the year. We would then show 60,000 less the balance that we had there, which was 11,750, close brackets, and I would be disclosing an amount of, well, this less that gives me 48,250, and this is what you would show as an extract in your non-current asset section of your statement of financial position. 2C, explain how Sam observes the accounting concept of prudence by providing for depreciation on his machinery. Okay, it's a nice question. So prudence is providing for the future. Okay, well, inverted commas, future. You're trying to create a provision now that relates to something that has occurred, okay, that will have an impact on that particular asset. So to describe the machinery was bought for a specific amount, bracket, that's the cost price. The cost price represents the value when purchased. As machinery is used, it loses value, and the depreciation is what we are recording. So we know we've still got the asset, and we can't change the past. When you buy the asset, it costs you a certain amount. We can't undo that. But we know that we'll never ever get the same amount for that particular asset, because the older it gets, the less value it has because of depreciation. So that's what you're trying to do here when you're providing for depreciation. You're creating an expense that relates to the value of the asset. The asset is losing value, and therefore you show that because the definition of an expense is an outflow of benefits. So you've actually lost something. You've lost that value of that particular asset. And that's question 3. Question 2C, the third question in this particular assignment. Thank you for watching. Please consider subscribing to the channel, and if you have any questions or comments, post them below, and hit the thumbs up button if you like the video, and we'll keep creating more to help you.